Hello everyone. So today we are going to study the topic income from house property. This is the one of the head from the calculation of total income of the SSE under the Income Tax Act 1960. In this chapter, we are going to understand about the various topics like chargeability section of the house property, exempted properties, computation of income, taxes levied by local authorities, deductions, partly occupied and partly let out house properties. So let's start with the chargeability of this section. Annual value of the property shall be taxable under the head income from house property subject to the following. House property. There must be a property consisting of any building or land thereto. Next is owner. Assessee is the owner of that property, not used in business or profession purpose. Such property is not used for the purpose of taxable business or profession carried on by the owner. The basis of charge of income under the head income from house property is the annual value of the property. Annual value is inherent capacity of property to earn an income. It is the amount for which the property might reasonably be expected to let from year to year. Income from house property is charged to tax on notional basis, as generally tax is not on receipt of income but on the inherent potential of the house property to generate income. Next, computation at a glance means before moving further, we should know about the process of calculation of income from house property. There are various heads in this: gross annual value, less municipal tax, then we get net annual value. From the net annual value, we will less the deductions under section 24A and 24B. Then at the end, we will get income from house property. So basically, for calculating the income from house property, we must know about the gross annual value, we must know about the net annual value, we must know about the deductions. Then only we can find out the income from house property, which is to be taxable under the head income from house property. Moving ahead, for working on income from house property, there are certain conditions which needs to be satisfied. First condition, the property must consist of buildings or lands to such buildings. Second, the assessee must be the owner of such house property. The property should not be used by the owner thereof for the purpose of any business or profession carried on by him, the proper profits of which are chargeable to tax. Now, moving further, computation of gross annual value. It is divided into three steps. Step 1. Calculate expected rent as follows. For calculating expected rent, we must know fair rent of the house, municipal value of the house, and standard rent. So, in this chart, you will see fair rent and municipal rent are mentioned here, and the amount is consideration from A and B is whichever is more. Then, standard rent, expected rent is whichever is less from C and D. So in first step we have to calculate expected rent. Then step 2, compare expected rent and actual rent receivable where the property or any part thereof is let out. If ARR is more than ER referred to in step 1, then GAV equals to ARR. If ARR is less than ER and it is due to vacancy of property, then GAV equals to AR. If ARR is less than ER owing to vacancy, then GAV equals to ER. For notification purpose, ARR here equals to rent received divided by or receivables less unrealized rent. Moving further for step 3, we should know before that the net annual value. The net annual value is the sum is computed after deducting from gross annual value the taxes levied by any local authority in respect of property. It is determined as NAV equals to GAV minus municipal taxes paid. Next, we should know about the meanings of the following things or terms. First is municipal valuation. For collecting municipal taxes, local authorities make a periodical survey of all buildings in their jurisdiction. Such valuation may be taken as strong evidence representing the earning capacity of a building. Second, fair rent of the property. Fair rent of the property can be determined on the basis of rent fetched by a similar property in the same or similar locality. Third, standard rent. Standard rent is the maximum rent which a person can legally recover from his tenant under Rent Control Act. Next, what is self-occupied property? Property is considered to be self-occupied where property consisting of house in the occupation of the owner for the purpose of his own residence or such property cannot actually be occupied by the owner by reason of the fact that owing to his employment, business or profession carried on at any other place, he has to reside at that other place in building not belonging to him. In case of self-occupied house property, net annual value is always zero. Since NAV is zero, the municipal taxes paid by the owner of the house are not deductible. Now, what are the deductions available? Deductions are available under section 24 are statutory deduction and interest payable on capital borrowed for acquisition, construction, repair, renewal or reconstruction of house property. So these deductions are permissible while calculating income from house property. Statutory deduction means compulsory deduction. Second point, which is interest payable, is only be incurred if there is any type of interest is payable or not. Deduction for interest on capital borrowed in case of self-occupied property. Maximum limit of deduction in respect of interest on capital borrowed in case of self-occupied property whose annual value is assessed at nil is rupees 1,50,000. Here in this chart, two cases are mentioned. Interest on capital borrowed on or after 1st April 1999 for acquisition or construction of house. Maximum deduction is 1,50,000. In any other case, maximum deduction will be 30,000. Moving further, recovery of unrealized rent. If any type of recovery of unrealized rent happens in the previous year, then shall be deemed to be income chargeable under the head income from house property. 100% of amount actually received is taxable in the previous year or in which it is realized. Moving further, arrears of rent. It is deemed to be income chargeable under the head income from house property. It shall be charged to income tax as income of previous year in which it is received. For calculation purpose, taxable amount can be calculated as the amount received as arrears of rent less 30% of such amount. After deducting this 30% of such amount, the amount coming is treated as taxable as arrears of rent. This 30% is deduction is on the basis of under section 24 of a standard deduction. Now, income from the following house properties are exempted from tax. So basically, these are the incomes which are totally exempted from income from house property. Any one palace or part thereof, an ex-ruler, provided the same is not let out, is exempted. House property of local authority, exempted. House property of an scientific research association, exempted. House property of an education institute, exempted. House property of a hospital, exempted. House property of a person being resident of Ladakh, exempted. House property of political party, exempted. House property of a trade union, exempted. A farmhouse, exempted. House property held for charitable purpose, exempted. House property used for own business or profession, exempted. Hope you all have understood